when a commodity is in severe enough oversupply that it is selling at a discount to the cost of production, the stage is being set for a dramatic rebound.
Did you know that some of the most hated assets in the market are poised for a dramatic rebound? Rick Rule highlights three critical materials: nickel, lithium, and uranium that are facing severe oversupply and price drops, setting the stage for a potential explosive comeback. Nickel prices have plunged by 50%, forcing production cuts worldwide, which will impact supply in the next few years. Lithium, once in high demand for batteries, has seen its price drop by 75% as production capacity increased, leading to oversupply. Rule predicts that in 2 years, lithium might be regarded as a four-letter word by investors, much like uranium once was. Speaking of uranium, it has already rebounded from being severely hated, with prices skyrocketing from $20 to $90 per pound. Rule explains that uranium's shift from a spot market to a term market is creating stable, long-term investment opportunities unlike any other commodity. These dynamics suggest that the current low prices and oversupply in these markets are temporary, and savvy investors can expect significant gains as these materials rebound.
There's a lot of good things happening in the industrial materials business. Copper is priced well enough that you're going to maintain current production. You're not shutting in mines, but it isn't priced well enough to incent very many new mines. Meanwhile, there's political risk to copper production around the world, highlighted by Panama stealing the Cobre Panama mine, 3% of world's copper supply. Probably of more interest to me are materials like nickel, which has fallen by 50% in price. You'll recall from earlier discussions that we've had that the cure for low prices is always low prices. And they're shutting in primary nickel production around the world, which will have an impact 2 years from now or 3 years from now. My favorite industrial material subject, because it's so educational, is lithium. You know that lithium went on an absolute tear as demand for lithium-ion batteries, among other uses, soared. We were never short of elemental lithium. We were short of the refining capacity to turn it into something useful. Lithium quota went sixfold. We went around the world looking for lithium. We'd never looked for it before. It isn't hard to find. We found tons. Meanwhile, the industry was debottlenecking productive capacity. So now the lithium quota is off by 75%, with lots more coming on the market. My suspicion is that 2 years from now, maybe, lithium will be regarded by investors as a four-letter word, the same way they regarded uranium. And when that happens, there's going to be wonderful opportunities. You're going to be able to pick up lithium deposits that cost, $300 or $400 million to discover and put in production. You'll be able to pick up these things with 30 or $40 million market caps because people are going to hate lithium. That's the way the industrial materials market works. When a commodity is in severe enough oversupply that it is selling at a discount to the cost of production, the stage is being set for a dramatic rebound. I think the easy money has been made. The move in uranium from $20 a pound to $80 or $90 a pound was the easy money. And uranium went from being really thoroughly hated to being of interest to people. Well, the easy money has been made. I've now sold enough of my uranium stocks that I have no net investment in my remaining uranium stocks.
Wow.
What's important to do, and we don't have time to cover it, is because of the changing structure of the uranium market, because the market is progressing from a spot market to a term market, the sure money is ahead of us. In uranium, unlike any other commodity that I know of on the planet, producers and consumers can enter into contracts which specify prices and terms in the 15 or 20-year time frame, which means that you take the guesswork out of the commodity price and you take a lot of the guesswork out of the margin. This doesn't occur in any other commodity. So the ability to value a pre-production stage project with certainty exists in uranium where it doesn't exist anywhere else. This has absolutely fascinating implications. I think in the near term, surprisingly small. I think one knock-on effect may be the price of landed liquefied natural gas from the U.S. into Europe with the anticipation of the return of Russian gas. I think the underlying problems that we face, both regards to supply and also to the fiscal cliff, wouldn't go away. There might be a downdraft in the gold price because people mistakenly believe that concern around geopolitics is responsible for the strength in gold. Mm-hmm. My suspicion is that the budget pressures in the United States, even after peace in the Ukraine, would still be extraordinary. I think Congress would find something else to waste the money on. I think it'll be a real challenge, not just because of the destruction of the Nord Stream gas pipeline, but also because if past is prologue, when the Russians need money, they clearly need money now, like they did in 1990 and 1991, they defer sustaining capital investments. So my suspicion, if 1990, 1991, 1992 are any indication, the Russians are not reinvesting sufficiently in maintaining production and transmission capacity within Russia. And that'll be a challenge. It'll take 2 or 3 years to cure that. The United States isn't buying Russian oil. The Indians are buying Russian oil. So the oil that was going to India that's been diverted by Russian oil is now coming into the United States. Oil's very fungible. This is all political theater. There are ways that you can take if you want to get yourself out of the problem. I have a bank in front of the U.S. government for organization, so I'm not involved in any of that. The Russians would frankly welcome you if you wanted to surrender your ADR for ordinary shares, which trade in Russia. You can, as an American, open an account with Sibir Bank or other entities and trade in Russia. As I say, I have elected, as somebody who has a bank and organization in front of the U.S. government, not to engage in that type of activity, but it's out there to do. My suspicion is that ultimately we find some form of rapprochement with Russia. And I hope then that my ADRs will have value. The Middle East is an important source of global energy among anything else. And somebody chucking a missile in the Straits of Hormuz, shutting down the Straits of Hormuz from either side, which is to say the Shiites blowing up a Sunni tanker, the Sunnis blowing up a Shia tanker, would have a dramatic impact. Of course, the Houthis are, trying to be problematic in the Red Sea. A bunch of the Saudi crude now crosses Saudi Arabia and is in fact loaded in the Red Sea. So they've taken some steps to loosen their dependency on the Straits of Hormuz. But if things really, really, really went wrong in the Middle East, all bets would be off in the conventional energy market. There's a lot of short-term demand inelasticity with regards to price in energy because it's so critical to what we do. To be honest with you, I'd rather not venture a guess. I'm not sure how it would impact the import market for raw materials into China. I just don't know. I suspect that were Trump to prevail, that equity markets would be stronger. Oil markets, or at least the market for oil shares, would be much stronger, given the electorate's belief that he's pro-energy. From my own viewpoint, without belaboring it, I personally wouldn't vote for either of them. But that's a very different statement. My suspicion is if Mr. Trump won in the short term, it would be good for the economy and it would be good for energy stocks and perhaps resource stocks in the sense that he seems to be at least less hostile to energy and resource development in the United States.